Everything is changing so quickly during this tech boom. Prices are inflating, companies are exploding, share prices are rocketing to the moon faster than a Donald Trump crypto pump and dump. I have tried to keep up with some of these stocks, but I'm running out of capital and fast. It is not possible, guys. People are in debt, they're struggling with higher costs of living, and we're all feeling the weight under the boot of $5 gas around the country. We're seeing that glimpse of financial freedom slowly sink to the bottom of the Strait of Hormuz. So, logically, then, guys, our only objective right now is to figure out what to do with our money. Our decisions for what to do with our money over the next 5 to 10 years, it starts now. This is a huge opportunity, unlike any other. It could be the next big thing, and we need to get on it, and we need to get on it fast. It feels like every time I load up Yahoo Finance or something like that, progress is happening so quickly across the board. And if the AI boom really is for real, unlike .com, where do we put our money? Because realistically, guys, we're not going to be doing any day trading, right? We're not going to be doing, crypto that isn't like Bitcoin, and we're not going to be doing anything absurdly risky. Now, before we get into this video, guys, remember, I am not a financial advisor and I am not a financial professional. I possess absolutely no certifications or training. I'm just a guy that spends too much of his time at work reading Wall Street Bets instead of being a productive member of society, optimizing our deliverables, and increasing shareholder value. So, I wanted to discuss a little bit today about my personal investing philosophy, how you too can get in on the AI boom, and how to hedge yourself accordingly in a market that seems to be all but rational. So, the first thing, after everything that I've been through, I've been investing now for about 10 years, and my philosophy has remained pretty consistently stagnant. And that is, you need to invest. The key word here is invest. You are not here to buy a company and sell after a 40% run up. You are here to invest in companies and hold them for the long term. But what should you invest in as a core? Well, I'm glad you asked. Low cost index funds, guys. It's boring. I know I'm not winning an award for telling you to do the same shit that you can get over at r/Bogleheads or any respectable finance tuber that isn't trying to offload their bags in some garbage stock that got pumped. No, guys, we are here in low-cost, broad index funds as core holdings of a strong portfolio. So your core, at least mine personally, how I constructed my portfolio, is I have 60% in the S&P 500, I have 25% in international developing markets, I have 10% in small cap US, and 5% in international developing. I keep the rest in diversified bonds like mortgage-backed securities, har, Michael Burry, har, and cash. So this is my personal portfolio. You don't have to mimic it. This is just what I do personally. It works for me. But what else I'm buying is dividend growth ETFs to eventually build passive income vehicles, extra streams of money. I'm a lazy guy. I'm never going to get into like drop shipping or anything like that. I just want to set it and forget it and for the money to make money in its sleep or in my sleep. So these are ETFs like DGROW, SCHD, VIG. The strategy is simple. It works. It will provide for you provided that you remain consistent and do not panic sell. And I use the returns generated from these holdings to catch some faster growth. I'm not keeping a large amount of cash right now because, world reserve currencies do not last forever. And I'm a huge tinfoil hat guy. I do not trust the Fed as far as I can throw them. So beyond that, if I'm using some of these interest generated in order to buy, high growth tech stocks or something like that, if I can't, explain it to a friend in a few minutes, like if I can't elevator pitch it, I'm not going to buy the company. I don't invest in things that I can't explain. So I'm never going to buy a quantum company. I have a bachelor's degree. It's in humanities. I never got any sort of, I'm not in biotech. All right. I got a C in like high school biology. Like I'm not that guy when it comes to that sort of thing. I will never be able to explain to you how clinical trials work or complex biochemistry. I'm never going to buy it because, unless I FOMO in after, a couple whiskeys too much in the evening. All right. So our primary focus should be on income that is always going to remain highly consistent. These are our financial freedom companies. Things like, ConocoPhillips, Chevron, Verizon, Waste Management, Costco. These are companies that are going to consistently grow, appreciate in their dividend payouts, and you can set it to DRIP, so the dividend reinvestment program, so that it buys more shares of itself. This is what will get you to financial freedom. Like Costco is not going anywhere. Even if there's a recession, people are still buying those rotisserie chickens, y'all. Like high quality dividend paying companies do not get hard hit like growth do during market drawdowns. These will take care of you. Next point, tech that compounds. These are companies that are going to give you the extra capital to augment that Roth IRA, reinvest into your main holdings. And yes, when you are trimming shares, there is that additional tax drag, but this is good during growth opportunities right now because we should be betting on the AI boom. You're going to get FOMO. You cannot stay on the sidelines during a time like this. We unless you didn't miss it, SanDisk and Micron have had insane run-ups in the last year. If you got in on that, congratulations. Transfer it to me. I should have happened to me instead. But you can still get into this by diversifying properly into specialized ETFs like DRAM, which is for your memory stocks, or SMH, which is for semiconductors. Hilarious ticker, by the way. The more broad version to go into something like this is QQQ, which tracks the NASDAQ. It's more volatile than the S&P 500, but it also, can return more than the S&P 500 during a particular tech boom. So the risks are higher, but hedge yourself accordingly with your risk tolerance. Now remember, your risk tolerance is higher during a bull market. I know mine is. I would probably panic at like a 30% drawdown. I might even sell, because I just know I'm not built like that. But during this period, I have invested in companies like Nebius, CoreWeave, Intel. These are, for building up extra capital to put into, higher compound engines like SCHD, things like that. There's a lot of opportunity out there, and you should be doing your research. But just remember, individual stocks are so risky. It's boom or bust right now, and it's an arms race in the AI boom. So maybe you're just better off picking Google. I don't know. Nobody knows. That's the beauty of it all, right? Next point I wanted to discuss is American business versus international business. So as we know, the U.S. is very much in an interesting political position because of, Orange Man sponsored geopolitical uncertainty, but that does not change the fundamentals for the U.S. markets. We have the most access to capital. We have lower business regulations. We have crazy fast innovation, and we can buy the best talent all over the world. And the USD is also, still the world reserve currency. This could change in the years to come, but if you've bet against the US in the last 50 years, guess what? You've lost bigly. All right, you've missed out on the boom. You're forever, cooked. So betting against the US market, hedging into global markets, it can be smart going forward. Personally, I do buy some developing market funds, and this is to go into the next point. So there is a lot of potential in the global market. So regardless of US performance, diversifying against it is almost always a good idea because the S&P 500 did underperform from the dot-com crash until about 2014 when it started significantly going back up again. So if you had been diversifying otherwise, if you had been buying, reliable dividend stocks, you probably still captured a pretty significant amount of growth during that period. However, it would have, still not worked against the broader US market. Now, I'm not a CCP bot, but I do believe in China and its growth potential. So I am buying up mutual funds that capture Chinese equities. So I get exposure to those markets. There's a lot of potential in especially Asian markets, with things like Samsung. Sea Limited is another one I've been looking at. Alibaba, Tencent, Nintendo. For whatever reason, Nintendo's sitting on an insane amount of cash. So if and when eventually this RAM shortage ends, I'm sure they're going to see some pretty significant recovery. But this is just another way to diversify your portfolio, during this tech boom. It's not just occurring in the US. It's not just, those high growth, high promise AI companies like that Allbirds, that shifted from selling shoes into, into saying they're an AI company. I don't even know what that means. So, there opportunity abounds, guys. There is plenty of possibility everywhere. So to hedge against this further, insurance buys. So like we said earlier, the US dollar is consistently inflating. It's a fiat currency. It has no intrinsic value. Neither does Bitcoin, but we've assessed, value to Bitcoin, gold, and silver. So that's how you hedge against the weakness of the dollar. I personally am buying more Bitcoin nowadays. I think, there's a lot of potential during this next cycle. It's always a good idea, I would say, to buy Bitcoin because it's a decentralized currency. It has a finite supply. So there are ways that you can hedge yourself against this. So to sort of summarize, boring, disciplined investing is what will actually make you rich because you're reinforcing this as a lifestyle rather than as a trend. We're not here to trade. We're not here to do zero DTEs or gamble in the stock market. All right. As much as I reference Wall Street Bets on this channel, I sort of go there as a sobering reminder that I am not a fucking moron. I mean, I am an idiot, but like I'm not that stupid. So minimize your stress as much as you can. Investing is something you're going to be doing for such a long time. So don't spike your cortisol by FOMOing into shit stocks like IREN and sweating over your Robinhood, not being able to sleep at night, worrying about whether or not you're going to ask your wife's boyfriend for some more margin so you can finally buy another stock that is going to put you in the cuck chair for another month. All right. So remain consistent, so to sort of summarize, guys, your focus should be on those dividend growth vehicles. You should buy tech that compounds. You should, tilt more towards American businesses because that, by all indicators, is where the growth is. But don't forget to diversify into global markets, and don't forget to hedge against the dollar with things like Bitcoin and gold. As always, guys, I hope you found this video helpful. Again, I'm not a financial professional. I'm just an idiot with a computer and a mic. But I really appreciate you guys watching the video as always. Be sure to like, comment, and subscribe, and I will see you in the next one. Peace.